Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So we'll follow the normal format. So just as I get you to look at the second disclaimer, we'll follow the normal format, which I'll just run through shortly, and what we're going to get through in the next 30 minutes or so. Our goal really is to break down all the market jargon and complexities that we all read about, that you read about. So if you do have any questions, please do ask them along the way, and we'll hopefully answer those as we go, or at least at the end of the webinar when it finishes. Okay, it's just after 11 a.m. in London, so let's get to it then. First up, I'll just show you what we're, as I said, hoping to get through in the next 30 minutes or so, which is to check out how markets are trading currently. We'll then look at some of the trade war themes, of course, which are lingering, looming, ever present over the markets constantly at the moment. We'll also look at Nvidia's results from last week, actually. Just check out the highlights from there, just some of the implications and what to look for going forward, as well as looking at the chart, the stock price of the chart as well. We'll then go through some of the US stock indices, just those charts as well, see some of the key levels that we're getting to in those. Before then, a quick look at last week's main events, US inflation data, and also the RBNZ was quite interesting. So we'll look at Kiwi dollar along the way. Before then, looking at a preview of this week's main events coming up. Bank of Canada meeting, of course, ECB meeting tomorrow. So we'll look at euro dollar, we'll look at dollar CAD, and then of course Friday's non-farm payroll report, the US monthly labor data, which we'll have a graphic for with all the main numbers to look out for, and also then look at the DXY, that's the dollar index chart. So firstly, let's just check out where we are currently, and with trade related news really continues to dominate markets. As I said, President Trump, well, he announced recently US was raising import duties on the import of steel and aluminium from 25% to 50%. That is now starting today. That's been confirmed. Of course, we had this sort of tit for tat with China, just sort of accusations going between both sides really. Chinese officials accused the US of violating the consensus reached in Geneva. That was over the weekend, I think, warning they may take additional action to defend their interests. Then we had Donald Trump overnight, actually, I think, tweeting that, yes, great friends with President Xi, but also he was extremely hard to make a deal with. Interesting because there's been a lot of speculation about whether or when Trump and Xi are speaking directly. That was meant to be this week, and it gave a lift to markets. But now, yes, we're not sure whether that conversation has taken place or not. But certainly, Donald Trump has tweeted overnight, as I say, kind of insinuating that yes, they've spoken and it's hard to make a deal with, even though they're good friends. I'm just speculating here, of course, that I'm no backing up that they have spoken, and potentially that may just happen later in the week. Initially then interesting because trade, or the flaring up really of these trade related tensions, that did cause risk off bias at the start of the week, but that has been turned around over the past two sessions in stocks especially, and we'll get to those shortly. And it looks like an upside breakout certainly in the S&P, the benchmark US index. The dollar though has lost ground again this week. Small bid today, but yeah, losing ground and broke down again. The start of the week, of course, uncertainty still really high, and that's not helping. Well, it's not helping the dollar, certainly. Stocks kind of ignoring the uncertainty being bid up on fund managers who are sort of climbing the wall of worry, really, we would say, and then also US Treasuries, interestingly, well, they've been rising those yields this morning, so Treasuries being sold. Just last week, just quickly, US Trade Court, just to highlight this more sort of uncertainty, just to throw in there, of course, just to remind you, they ruled against tariffs imposed, but then product-specific tariffs were not part of the ruling. We're still yet to hear what happens and they may take a few months because the Trump administration appealed that decision. As I say, product-specific tariffs probably will replace current country-specific measures if the Supreme Court, the US Supreme Court, ends up confirming the trade court ruling over the summer. So as I say, we'll take a few months that, but then the Trump administration likely to get around it with product-specific tariffs in pharma, in tech, in those type of areas. Of course, legal challenges just sort of continue the uncertainty again, and certainly US trading partners now may also be reassessing the most likely outcomes. Okay, that's just some brief thoughts on what's happening with the trade news, the trade war, and just a few thoughts around that. Let's move on to NVIDIA now. And I've just pulled up the NVIDIA chart, actually stock chart. So just running over those strong, really quarterly results we saw last week. Kind of summary, really driven by robust chip demand, successful Blackwell rollout, and expanding customer diversification, and that was all despite a significant 8 billion revenue hit from those US-China trade restrictions. So just on the numbers, remarkable quarterly revenues, just over 44 billion. That was up a stunning 69% year over year, and that comfortably surpassed analyst forecasts. Data center segment, that's central, of course, to NVIDIA's success. That soared to over $39 billion. That's a 73% increase year on year. That data center revenue, now dwarfs all of its closest rivals combined, actually. So that just underscores really NVIDIA's dominance as the preferred supplier of AI infrastructure to all the giants like Amazon, Microsoft, Alphabet, and Meta. Gross margins, they were 71.3%, still exceptionally high, although that excludes the China-related inventory charges, and it all really underscores the company's robust operational performance, and they guided then the next quarter revenue of 45 billion. Broadly in line with analyst expectations, and that is, again, despite that 8 billion hit from China restrictions. Bottom line, really, you have to say, NVIDIA at the moment, well, it occupies quite a unique, complex position. So it's kind of right in the middle of transformative AI innovation, of course, and then also sort of geopolitical tensions as well. The risks, of course, come from China. They're significant, but so too, of course, is that sort of strategic opportunity globally. And that's being seen by new partnerships really in places like UAE, Saudi Arabia, across the Middle East, and they're keen to build new data centers, which will need, of course, a lot of chips, essentially. Probably the immediate challenge for NVIDIA then, and for us as investors really potentially, is just navigating these geopolitical storms while delivering, of course, on their sort of roadmap, their technological roadmap that they have going forward. Any missteps, I guess, could change investor sentiment, of course, as well as potentially the crazy amounts that the mega caps are spending on this rollout and the potential benefits, which we may not see for some time. Just reading recently a very good report by one of the investment banks just about the fact that, yes, more and more companies, up to 78% of the companies surveyed in one of these surveys, are using AI, but there's just sort of 3 to 5% of revenues generated from that, and productivity just below 10%. So really the sort of revolution, disruption, if you like, is potentially more about diffusion really. So it's gradual integration, uneven adoption, of course, between countries, and then just modest gains at the moment. Yeah, just some thoughts on that and AI, of course. As for the stock, you can see really big, decent rebound, and we'll show you the stock indices actually, which have pretty much US stock indices followed this shape, this V-shaped recovery, if you like. 86.62 the low after Liberation Day in early April. We're now up to 141.22 that you can see. Decent gain yesterday and the day before, so we're just approaching this initial high at 143.49, and then you've got obviously the all-time high at 153.13. Pretty decent bullish momentum, just ease back, actually ease those overbought positions you can see on the RSI. We're well above the 200-day moving average. That's that black line at 126.99. Now if I just pull back, yeah, we're just trading above now a minor fib level of this move lower. That's a 138.90. And then below that, you've got a major fib level along with that 200-day moving average around 127.72 is a 61.8 retrace. Okay, that's NVIDIA. If we just go to some of the other US stock indices as well now, let me just pull up the S&P 500. Futures, just looking at those, they're just up around 0.18% now in the S&P, so building on this decent looking breakout potentially through 6,000, and then obviously the high at 61.47 you can see there. We were trading around that 78.6 retrace level of this V-shaped rally, if you like. That's at 58.66. I've got this swing high in here. I'm not sure why. I'll take that out. So yeah, 58.66, interesting level, capped the downside really over the last few days. We're just bouncing off now through this recent high from mid-May at 59.68. So yeah, 6,000 next kind of psychological barrier ahead of 61.47 with support at 58.66, and then below that you can see the black line, the 200-day moving average, that's at 57.90. As for the Nasdaq, similar looking chart and breakout potentially. Futures up 0.17%. Just pull that up. That's the futures. And there's the cash, so you can just see again similar chart, found support around that 78.6 level, just above 21,000, all-time high at all the twos, it looks like 22,222, and this breakout looks pretty good, even though we're coming potentially into overbought territory on that daily RSI. As for the Dow, hasn't done as well. Tech's been leading the way, and I'll show you a chart briefly when we get through these technicals. But here, yeah, you've got the 200-day moving average that's kind of capped the upside over the last couple of weeks. You can see that's at 42.431. Then that recent high at 42.842. And we should probably put in the 78.6 retrace, apologies, just here. So next upside level, if we break that recent high, would be 43.347. That's a 78.6 retrace level, at least, of this downtrend, and then the big rebound. Just a couple of charts to show you as well, which are obviously just generally this rally that we've seen, and we've just gone into detail with the S&P and the Nasdaq, but you can just see really strong V-shaped recoveries in all these global stock markets, the Australian ASX, the Nikkei, the stocks Europe 600 as well, and then the DAX, which has hit all-time highs. And then sort of moving on from that theme as well, then you just got the Mag 7 here and their performance year to date really, and you can just see how some of these, well, generally they've been leading the way with their recovery, with tech leading the gainers since sort of that early April sell-off, and then you've got Meta, Microsoft, NVIDIA, all now pretty much positive on the year. This is probably from last week actually when I did it, but this is probably picked up as well, these stocks. So NVIDIA in the green on the year, Meta, Microsoft definitely up on the year, and then the laggards, although Tesla's been improving recently, of course, big bounce from the lows. Apple and where are we? Amazon as well, just slightly in the red, but moving up in this week especially. Okay, let's move on now to last week's main events, just quickly running through some of the key events there, which we think are important to just have a glance over. First up, US core PCE data. So this is the Fed's favored inflation gauge and a key metric really for policy makers. They prefer it more than the CPI data, which is obviously released next week out of the US. It's the Fed's favored inflation gauge because it's a broader measure really of price pressures really. And yes, the numbers last week, well, month on month rose 0.1% and year on year 2.5%. That's the slowest rate of annual inflation since March 2021 that I put here. Just for your guide with this chart, it's courtesy of an investment bank, ING, but the black line in the chart is the month-on-month figure actually needed. If averaged over time, then the Fed would deliver the 2% inflation target. That's at 0.017% month-on-month. And the blue bars just shows now that we've had 2 straight readings that were well below that reading. So that is positive, of course. Also note that the so-called super core measure that excludes housing even posted a negative month-on-month print for the first time since April 2020. So interesting readings on this PCE data. Obviously, both the Fed and the market are worried that President Trump's tariffs will lift goods prices quite markedly in the coming months. That's then meant to limit the Fed's ability, obviously, to support the economy if weak consumer survey evidence translates into much softer hard spending data, and that's not what we've seen so far. All the survey evidence is soft, whereas hard data is still generally pretty solid. So interesting, yeah, PCE data. Also, we think we should highlight the fact that, well, it's different over the medium to long term. So tariffs really are a one-off step change, if you like, to prices, and their effect will drop out actually of the annual comparison in 12 months time. So that's something to note, and certainly in Trump 1.0 really in 2018, 2019, the Fed did look through the sort of one-off effect and really focus more or less on inflation and more on the downside effects to growth. Along with that, we should also mention the US is, well, it's overwhelmingly a service sector, and the cost of employing workers is the biggest input, and that has slowed rapidly over the past year. So a couple of things to bear in mind with this data, of course, low at the moment, presumed to move higher, but then there are caveats to that, which we've just highlighted. Here, this just tariffs which are lifting. We had this chart a couple of weeks ago actually, but just worth bearing in mind, inflation expectations sort of rising sharply, but they've just pulled back actually probably quite recently as well, just on some of these step changes that are maybe looked through by policymakers, and also the slight easing in tensions between China and US, although they picked up, of course, this week. Okay, let's just look at the RBNZ actually. So I'm just pulling up the Kiwi versus the dollar chart, which you can see here. RBNZ, they cut rates by 25 basis points to 3.25% as widely expected. Overall, the message actually was more hawkish than expected. So the vote split was 5-1 in favor of a cut. Expectations were for a unanimous decision. And then rate projections, they showed an average 2.9% by year end. That's below the 3.1 from February's update, but not really signaling that we go for another cut down to 2.75%. Also, a couple of comments from some of the policymakers. Chief Economist Conway, he said rates are now close to neutral. And then Governor Hawkesby, he said, well, he sounded quite cautious on future rate cuts, basically saying we have done a lot of work. So key takeaway, RBNZ no longer committing to a set easing path. Any further moves, of course, driven by incoming data. Another 25 basis point cut to 3% this summer probably is likely, but that's probably been pushed out to August from July after this meeting, this more hawkish meeting that hawkish cut, if you like. And there were already questions about whether rates would go below 3% this year. And kind of given the lack of inflation progress and this hawkish tone as well, then probably that reinforces there may only be one more cut likely this year. That helped Kiwi dollar. And clearly it's a positive going forward, really, this move away from the dovish stance, which has been seen since July 2024. So help the Kiwi dollar, and you can just see recently, this week we popped up to 60.37, spot 60.50, sorry, 53, not 37, 53. But we just pulled back below that fib level now. That's a major fib level of this move from those highs in September 24 down to the lows in April. So that 61.8 retrace, so the bounce, the retrace, the Fibonacci level is at 60.36. That just capped the upside on quite a few occasions already. So just watch for that. If we can break above that, then 61.86 is the next Fibonacci level. Otherwise, the halfway point of this move is at 59.31. Okay, let's get to this week's main events now. If I just pull up, first of all, a couple of graphics. So non-farm payroll, first of all, that's on Friday. Here is a graphic of all the main numbers. Hopefully this proves of use to you. Probably should update that middle section. Actually, should just read cooler jobs growth expected, really. That's from the review actually of last time, so apologies. Yeah, cooler jobs data expected. Wage growth is actually picking up 1/10 from 0.2 to 0.3, but you can just see, yeah, consensus at the moment currently expects around 130k, 132k now. It might have picked up after those JOLTS figures. We'll get to those shortly. That's against the 177k in April. And there were revisions to that, with the 3-month average now at 155k, the 12-month average at 157, and the 6-month average much higher at 193. Unemployment seen unchanged at 4.2%, and that's noting that the Fed's March projections, the dot plot for unemployment by year end would be 4.4%. Then average hourly earnings predicted to come in at 0.3%, as I say, a 1/10 pickup from previously reported in April. And then we've got pricing here. Before we get to that, just on other employment data, well, weekly jobless claims data, that's the more frequent data, and the numbers that coincide with this sort of BLS non-farm payroll survey window, they showed initial claims picking up actually to 226,000 versus 216 in the April survey window. Conference Board's monthly consumer confidence data, that showed views of the labour market weakening in May, though the outlook for the labour market was less negative. In terms of the Fed's, the JOLTS data as well, we had recently yesterday that picked up actually, so was really signaling ongoing resilience actually in the labour market. And then in terms of the Fed's balance, still between sort of above target inflation. If you remember, there are two mandates, if you like. Dual mandate is price stability and maximum employment. So we still have above target inflation and we still have a solid labour market. And the recent minutes actually from the FOMC noted that the risk of higher inflation, higher unemployment have risen recently, and really officials saw risks of the labour market weakening in the coming months. And that would mean potential difficult trade-offs if inflation was persistent while the labour market weakens. So we will obviously get a good steer on that with these numbers on Friday. Obviously, the longer the uncertainty, trade uncertainty continues, then generally there will be a greater loss of momentum in economic activity, in hiring, business investment, and that's why potentially cooling in the labour market. So those are all the numbers. Also then current Fed money market pricing, just over 225 basis point rate cuts priced in. As I said, roughly 25% chance or so, 28% chance of the first one being in July, and that's and then probably the main fully priced, nearly fully priced for a September cut, and then one after that at the moment. Of course, then if we get a hot report confirming that ongoing resilience, then these rate cuts get pushed out potentially, and this number falls below 50 basis points, and that would mean a bid to the dollar. Although how long that lasts, just with one, obviously one report, we probably need to see quite a few to confirm this ongoing resilience, and that the trade uncertainty hasn't impacted hiring demands, if you like. Otherwise, a weak report, of course, just hammers home the uncertainty and potential more to come, and that would give a hit to the dollar and see pricing of rate cuts push above that sort of 50 basis point mark for the year. Just quickly, we did have ISM data this week, and we do have services data out shortly. Manufacturing, that came out on Monday and kind of confirmed actually the stagflationary risk to US trade policy. So activity data disappointed. The headline eased further into contractionary territory, actually at 48.5. But then the sub-series were less negative, although they do remain below 50. The issue was a sharp decline in imports, actually the most since the GFC in 2008, and that really does suggest further supply chain complications. On top of that, then we saw elevated prices paid confirmed, elevated prices paid, and that really confirms then ongoing stagflationary risks. That's where we have higher inflation and stagnation, as in slower growth. Services, they are out today and should improve a touch given the de-escalation, really generally in tensions with between US and China, obviously on tariffs being cut on Chinese imported goods to 30%, although obviously we're having ongoing discussions about and speculation about that this week. If we just pull up the DXY chart then quickly. Which is here, you can just see, yeah, pretty quiet day today after finding a bid yesterday. Looked like we were breaking down towards that low at 97.92. I've kept this descending bear channel in here, although obviously we're sort of out of it at the moment. I should just extend that, I guess. Whether we cap it with these 2 points here now. And go to that point there or so, but you get the gist. It's a descending bear channel. We probably have to break above the 50-day moving averages, that blue line at 99.58 to properly break out, if not higher, and probably above 102, these recent highs from mid-May, 101.97 that is, to break this descending trend. Otherwise, yeah, we've got this week's low from yesterday, that's at 98.58, and then that low obviously from late April in 97.92. Okay, also let's move on now to then the ECB meeting. And quickly just showing you expectations for the depo rate. Quarter point cut really is a done deal for traders. That takes the depo rate to 2%. Question now is whether the ECB pauses after what would be actually the 8th rate reduction in the past year. I think it's the 7th consecutive one. Economists and markets really do expect the ECB to hold steady come July before probably cutting once more before year end. There's around 54 basis points of cuts priced in for the whole of this year, just before tomorrow's cut. The economy is actually holding up better than many anticipated, really, and pausing really probably allows the Governing Council time to assess the impact of US tariffs, especially with the easing and kind of not easing of tensions between the US and China. Obviously, EU-US trade talks are front and center, and the 50% pause to July 9th is positive, but certainly there are large gaps remaining between the two sides. We do get fresh economic staff macro projections, and economists expect growth to be revised down a touch for both this year and next, while the inflation view is likely to be trimmed for this year to 2%, probably from March's 2.3, but possibly increase for 2026 to 2.3 from March's 2%. That certainly will be of interest for, well, the Hawks and the Doves really, and we may see some clashes again between those two camps, certainly with an eye on next year and potential German fiscal stimulus, which would potentially push up inflation, and the Hawks will be talking about, you would think. Recent remarks otherwise, Chief Economist Lane, he said he was confident the bank's task to bring inflation back to 2% is mostly completed. Otherwise, yeah, we have had comments from some of the Hawks about, yes, neutral levels being hit and being cautious on more rate cuts. Also interesting, I guess, aside from sort of monetary policy, will be the fact President Lagarde probably will be put on the spot about whether she's actually likely to complete her term after there were quite a few press reports last week that she basically held talks about leaving her post early at the ECB to lead the World Economic Forum. So just watch out for those during the press conference. Generally, though, probably she will be data dependent, won't give any or very, very little policy guidance will be given, if any, probably none, because of the uncertainty. Maybe a hint at sort of decent inflation data, and just touching upon that, of course, we had the latest inflation data this week where, well, the headline declined below 2% to 1.9%, mostly in line with forecasts, but following country data, but sorry, below the consensus forecast of 2% that was, and it's actually the first dip below the 2% target since September of last year. Core inflation, that declined to 2.3 from 2.7. And the below expectations of 2.4 print. And that was all really headline and core due to a drop in services inflation, fell from 4% down sharply actually to 3.2%. So yeah, encouraging signs for the ECB, and potentially may mean a more dovish message from them. And certainly President Lagarde, watch out for the press conference and how she will deal with these encouraging inflation figures. Remember, tariffs in the Eurozone largely seen as disinflationary as well, so falling inflation impact in the Eurozone. So again, watch out for questions around that. Let's just show you euro dollar now. Ooh. If I just pull up the chart, just bear with me. Which is here. You can just see we did break this upward trend line, but then that was just a pause, really found support on the blue line, which is the 50-day moving average. That's now at 112.31. Yeah, we've got the high at 115.72, sorry, and then recent highs from yesterday at 114.54. So support probably around 112.43, and then the 50-day moving average, that's at 112.31. Finally, let's look at the Bank of Canada. So we'll look at the dollar CAD chart. Interesting levels, really, actually, because we're just resting on 137 sort of level or so. We did break down at the start of this week on Monday down on 136.73, but we're just holding around this sort of Fibonacci level around 137 or so. Bank of Canada, interesting because no rate cut is expected by markets. That is today, this decision. About 6 basis points of easing priced in, so that's around a 25% chance of a rate cut. But I know that a lot of economists following the Bank of Canada are more torn, and there is a potential for a move that they see, although money markets much less pricing of that move. So a close call. We've had recent hot inflation data, but before that, actually, there was around a 60% chance of a 25 basis point rate cut. Unemployment, well, that's in danger of breaching 7% this week when we get those jobs figures on Friday as well out of Canada. Despite a low headline inflation print, core CPI has been moving higher. We also got a strong Q1 GDP print, but of course, in amongst this, trade is critical given the importance, of course, of US exports to the Canadian economy. And of course, while there has been a sort of calming intentions after Prime Minister Carney's trip to the White House, obviously we can't take anything for granted between the two neighbours. Just for your guide, at the prior meeting, actually, there was no guidance due to the uncertainties ahead, so that's probably likely to happen again. And from the minutes of the meeting, they found that the council was split on whether to cut or hold. And those who favoured a cut cited near-term inflation risks and signed that the economy was weakening. Looking ahead, money markets, they price in around 16 basis points for a rate cut in July and around 38 basis points of easing throughout the year. Possibly slightly underpriced. We shall see, of course, today whether there are hints at a sort of dovish hold or a cut and a more neutral sort of tone. Interesting call, and especially with these levels here. So 137 sort of decent initial support. Otherwise, then we just get down to these sort of swing lows from the middle of last year, just below 136, and then you've got this major low at 134.20. Okay, we'll wrap it up there. Don't see any questions at the moment, so really hope that has been clear for you guys. I really do appreciate you being on the call. Yeah, good luck out there. Lots happening, of course. So yeah, just watch out for headline havoc as usual with trade-related headlines, and then obviously some hard data to look at. Non-farm payrolls being the key one, which will be really interesting for the tariff impact or not. And of course, ECB and BoC as well to look forward to. Take care, and we will speak to you in a couple of weeks.